Hi, my name is Greg Forstoffel, and this is my analysis of the performance of United Bank and Trust for 2010. The only reason I'm doing this in a video is because I can't figure out how to upload the slides to my website. So away we go. Usually in most analyses, not always, but most of the time people like to look at the income statement, so we will start here. The bank's income is typically separated, I guess, into three different pieces. Piece number one is interest income. The bank's job is to lend money, so it borrows money from depositors and other folks, and it lends it out to people who wants to borrow money. So what we see over the last several years is a constant net interest income, pretty constant of about $30 million, between $30 and $31 million. Next is non-interest income and non-interest expense. The non-interest income over the last several years, it's been increasing. 09 and 010 is increased over prior years. Non-interest income is significant for the bank because, as they say, you don't need capital to make your non-interest income, as opposed to up in your interest income. Regulatory agencies require that you have capital to back up the loans, or at least a certain amount. You don't in non-interest income. And you see an increase in non-interest income over the last couple of years, and I think the reason is because the bank is doing a bigger service, bigger business of making and selling loans and making money, being the middleman from that. I don't think they did that at all, or at least not very much, not to the degree. I think that is a response to the changing economic times and sort of a shift in strategy. And then you see the non-interest expense. Over the last couple of years, there was an anomaly. In 2009, the non-interest expense, this $37 million, included about $3.5 million of goodwill write-off. Absent that, the net non-interest income would have been pretty much in line with 2008, 2010, so that the core earnings looks pretty consistently between 13 and $15 million, maybe. 13, $15 million. And from that, you subtract loan loss expense. Loan loss expense is very simple. If loan loss expense is bigger than core earnings, there's going to be a net loss for the year. If loan loss expense is smaller than core earnings, then there's going to be a profit for the year. And as you can see, 8, 9, and 10, there was the loan loss expense was higher than the core earnings, so there were losses for the year. And you can see that the loan loss expense started going up in 2006. And these are, I think, are responses to, in other words, there's a delay, there's a lag. So the loan loss expense in these years are from, even up through here, are from loans made in prior years. So nothing that they did in these years caused this. It's, in my opinion, it comes from the lending practices back in here. And again, as you can see, the net income was sort of strong in 05, 06, 07, and then it just fell off a cliff in 08, 09, and 010. And to kind of put this loan loss in perspective, I made a couple charts. The blue here shows the core earnings that we saw in the previous chart. The red is the loan loss expense. And it shows how the core earnings have stayed relatively constant. Again, that was a little bit underinflated. If you apples to apples, you should add $3.5 million to that to put it up about 14.6, probably in line with there. So we're typically between 14 and $16 million in core earnings. But you can see how loan loss expense in these years just greatly surpassed the core earnings, and that's why there were losses. And looking at it a little differently, the blue columns again are loan loss expense, and we can see this is the cumulative loan loss situation, and starts at 8.6, and year over year it's exploded to $71 million. Now this is loan loss expense over those years. Over those years, they've written off in loans around $50 million, and there's still about $20 million on the balance sheet, just laying there ready to be written off as soon as the timing's right. So $71 million in loan loss expense, $50 million written off, $20 million on the books ready to be written off. And this, again, I hate to belabor the point, but I'm going to. This $71 million is exactly the reason that the bank had to go get TARP money of $20 million. It's exactly the reason that the bank last year had to look for new capital, because $71 million of their money is lost and gone forever, and they had to replace it with something. And that is what they did, the TARP money and the additional capital. Now we're going to look at the balance sheet quickly. And what we see down at the bottom here, I've shown growth year over year. The total assets were highest in 2009. Since then, total assets have dropped off by about 5%. And what we see is that the net loans have really decreased. The net loans gone from 630 to about 567. That is a drop of about 68 or so million dollars. These assets increased a little bit, such that the decrease in assets is about $40 million. And the reason for the decrease is severalfold. I think that economic conditions are such that people aren't looking to borrow money. The people who can are refinancing their loans at better rates. Some of them are paying it back, and some of them can't pay it back, and their loans have gone into foreclosure, into non-accrual basis, and all those reasons, the loans have decreased. And long term, it's challenging, but long term, this is a consideration, because that's where the bank makes most of its money, is in loans. And it's what we saw from one of the prior slides. On the liability side, what we see is short-term liabilities going down a little bit, and these are basically deposits, checking accounts, savings accounts, those kind of things. And I think at the end of the year, it's not necessarily bad that this is a little bit lower. I think the first quarter is going to show that these numbers are going to go up. People have local governments have money from taxes that they're going to put into their into deposits, so that will come up a little bit. What is unusual is to see two things. The total equity has gone up by $12 million, and what we see here is preferred stock. This is the TARP money that the bank took in 2009, and this jump from 68 to 85 is the additional stock that was sold in last year to new shareholders. The other thing to notice, retained earnings got even deeper, from negative 8.6 to negative 13.5. This is because of the net loss that happened last year. Did a quick analysis of the change in equity. Kind of showed you this on the prior slide. End of year capital was 80 in 09 to $80.8 million. It increased to 92.7. The reason it increased was this new capital, new stock that was sold back in October, November. did this, again, because of the loan losses. They had to by the regulators. The regulators forced them to do that. Um, the increase in capital was about 12 million. The new capital was 17 million. So where'd the other 5 go? The other 5 went, into the negative net income. So of the 17, 5 of it went bye-bye into the net loss of 2010. Now, very quickly, these are questions I hope that somebody asks tomorrow. I've asked before, and I don't seem to be getting any answers. Somebody else might be able to get some answers. Question number 1, what caused the bank to end up in such a bad situation that we've seen over the last 2 or 3 years and last year? I understand part of it was the economic situation in Michigan, but tell me what you did, you personally, as far as loan losses, as far as lending procedures, and other procedures that caused such a bad situation. Number 2, when does the loan loss bleeding stop? I've asked that before, and the answer I've always gotten is I don't know. I hope maybe he can give an answer to somebody else. Number 3, the bank's lost $72 million in loan loss accruals over the last 4 or 5 years. What has the bank learned about lending money and risk management? What new policies and procedures are in practice now that weren't in practice before? And why should we believe that we're not going to go through another phase of this kind of catastrophe? And number 4, when's the TARP money going to be paid back? I happen to think it's horrible that the government has a preferred stake in our bank, even though management says, hey, it's cheap money, I don't care. I wish the bank would get them out, and as soon as possible. That is it. Thank you very much for your interest, and I hope to meet you all someday.